Hey everyone! Welcome back to the channel. Today we're breaking down the 5 types of accounts in accounting. Whether you're a beginner or just curious about how businesses track their money, this is going to make it super clear. Stick around because, at the end, I'll tie it all together with a fun rental property analogy to make it all click. Let's get started. First up, we have assets. Assets are anything valuable that a business owns or controls and uses to make or save money. Think of them as the tools and resources that keep a business running and growing. For example, cash is an asset. This includes the money sitting in the business's bank account, which is essential for day-to-day operations. Equipment like machines, computers, or tools used to produce goods or provide services is another type of asset. A bakery's ovens or a tech company's computers fit this category. Assets can also include buildings like stores, offices, or warehouses, and inventory, which refers to the products a business plans to sell. For instance, a toy store's inventory might be dolls and board games waiting on the shelves. There's also accounts receivable, which is the money owed to a business by customers who've bought something on credit. It's like an IOU that will eventually become cash. Assets are the backbone of any business. Without them, there's no foundation to build or grow.
Next, we have liabilities. Liabilities are debts or obligations a business owes to others. It's like borrowing something with the promise to return or pay for it later. Liabilities are often necessary because businesses don't always have enough cash on hand to cover every expense up front. For instance, loans are a common type of liability. A business might borrow money from a bank or investor to buy new equipment, expand, or cover operating costs. Bills, such as payments owed for electricity, internet, or water, are also liabilities. Then there's accounts payable, which refers to money owed to suppliers for goods or services the business has already received. Wages payable is another example. It's the money owed to employees for work they've already done but haven't been paid for yet. Liabilities can actually help a business grow by providing the resources needed to scale, but they need to be managed carefully to avoid financial trouble. Now, let's talk about expenses. Expenses are the costs of running a business and keeping it operational. They're unavoidable and include anything the business spends money on to stay up and running. For example, rent is a typical expense, like the cost of leasing a shop, office, or warehouse. Utilities, such as payments for electricity, water, or internet services, are another common expense. Supplies, things used to produce or sell a product, fall into this category as well. If you're running a restaurant, the ingredients you buy are part of your expenses. Salaries and wages, the money paid to employees, are also considered expenses. And don't forget about advertising. Businesses often spend money on marketing campaigns to attract customers. In short, expenses are what a business spends to make money. A successful business keeps its expenses under control so they don't outweigh its income. That brings us to income, also known as revenue. This is the money a business earns from selling its goods or services. Income is the lifeblood of the business, and the goal is always to generate more income than expenses. Sales revenue is one type of income. It's the money earned from selling products, like a clothing store making money from selling t-shirts. Service revenue is another type, which comes from providing services, like a tutor getting paid for teaching students. There's also interest income, which is money earned from investments or keeping cash in a savings account. Income allows a business to grow, invest in new opportunities, and provide value to its owners. Finally, we have equity. Equity represents the owner's share of the business after all debts are paid. It's like the net worth of the business. There are 2 main components here: owner's capital and retained earnings. Owner's capital is the money or assets the owner invests in the business. This could be cash, equipment, or even expertise. Retained earnings, on the other hand, are the profits the business keeps to reinvest rather than giving them all away to the owners. For example, if a business has $100,000 in assets but owes $40,000 in liabilities, the equity is $60,000. This is what the owners truly own after settling all debts.
Now let's tie it all together with a rental property analogy. Imagine you own a rental property. The property itself, along with the furniture inside and the rent sitting in your bank account, are your assets. They're the resources you own that generate income. The mortgage or loan you took out to buy the property represents your liabilities. That's the money you owe. The costs of running the property, like repairs, property management fees, and utility bills, are your expenses. The rent you collect from your tenants every month is your income. It's the cash flow that makes the investment worthwhile. And finally, equity is the value of your house after subtracting the mortgage. Over time, as you pay down the loan and the property value increases, your equity grows. By understanding these 5 types of accounts, you can start seeing how businesses and even personal finances are organized. It's all about knowing what you have, what you owe, what you earn, what you spend, and what's left over. If you found this helpful, hit the like button, subscribe for more videos, and let me know in the comments. How would you apply these concepts to your own life? Thanks for watching, and I will see you in the next video.